All right, another day in the doldrums after some big spending announcements. 30 minutes until the cash trade. I'm Matt Miller. Danny Berger is off today. Bloomberg Open Interest starts right now. We do have a trade truce. President Trump calls his meeting with China's President Xi truly great, with a host of market-friendly details. And big tech's AI ambitions are coming with a massive price tag. Meta, Microsoft, and Google together racked up $78 billion in capex in the last quarter alone. Plus, Jay Powell pushes back, telling investors they shouldn't assume there will be a cut next month. This hour, we get the decision also from the European Central Bank. In terms of the stocks that we're watching, there are a lot of very big movers today. Meta getting absolutely trounced. The stock down more than 10%, so market cap decimated as Mark Zuckerberg says we should prepare for a notable increase in spending next year. Microsoft also down about 2.5%, spending more on AI, but not getting a faster acceleration in its cloud revenue. Alphabet going the other way because they are getting a huge pickup in cloud revenue as well as a huge pickup in users of its Gemini AI product. And then NVIDIA right now down 1.8% as we didn't get anything from President Trump about a discussion between himself and Xi on Blackwell chips. In fact, he said in a post on Truth Social that it wasn't brought up. So I guess he didn't bring it up. Trump and Xi did, however, agree to extend a tariff truce. Both countries will roll back export controls and reduce other trade barriers. President Trump spoke on Air Force One after his meeting with President Xi.
I thought it was an amazing meeting. He's a great leader of a very powerful, very strong country, China. And what can I say? It was an outstanding group of decisions, I think, that was made. A lot of decisions were made, too. There wasn't too much left out there. And we've come to conclusion on many very important points.
Bloomberg Washington correspondent Tyler Kendall has been traveling with the president. She joins us now on the ground in South Korea. So this meeting was a 12 out of 10, the president says. What did he achieve?
Yeah, hey, Matt. Well, it's clear that both leaders have now eased the tensions going forward, but at the same time, it's become evident that those structural, fundamental issues still remain unresolved over the long term. Now, China is going to get a reduction in tariffs immediately, as President Trump says that he is going to cut that 20% tariff tied to fentanyl in half in exchange for what he says are pledges from the Chinese president to curb those so-called precursor chemicals that go into making the drugs. Now, other than that, it really feels like a lot that was on the table is a pullback of the escalation that we've seen in recent weeks, right? We got confirmation that China is going to delay those newly unveiled export curbs related to critical and rare earth minerals and will resume purchases of U.S. soybeans. The Treasury Secretary confirming this morning that China is on track to purchase 12 million tons of soybeans, which actually is in line with many analysts' forecasts for the rest of the harvest season. Now, on the U.S. side, the U.S. is no longer going to impose fees on Chinese ships that are docked at U.S. ports. That was considered to be a key concession that Beijing wanted to see. And the U.S. is also going to pause a rule that would have expanded restrictions on some blacklisted Chinese entities and firms. Now, going forward here, though, Matt, our own analysts at Bloomberg Economics say that, while, of course, this is a welcome easing in tension, it does appear to only be buying both sides time to really strengthen their hand ahead of what is expected to be long-term competition for supremacy between the two countries.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall continues to travel with the president. We'll get back to her throughout the program. Turning back now to big tech, Meta and Microsoft slumping pre-market as they signal no slowdown in AI spending, but they don't have a commensurate acceleration in the revenue side. On the flip side, Alphabet rising from strong results in its cloud computing business, as well as Gemini adoption. This all comes as investors await Apple and Amazon reports today after the bell. Bloomberg Tech co-host Caroline Hyde, busier than ever before, joins us now at the desk, or I guess just me today. Yeah.
I love it when it's just us.
Wow. Thank you very much. Me too. Although, Danny, we miss you.
We miss you.
A slew of fascinating results, and I guess the spending is really front and center.
Spending is, and for some, they're rewarded, and for others, they're not. I think there's an element of what more did Meta or Microsoft need to prove to the market to vindicate that they're going to be notably spending more in terms of capital expenditure? Alphabet's raised its over capital expenditure to $92 billion at the top end, up from 85 that had already raised the quarter before. But because you're seeing the traction with Gemini, because they're talking about the cloud growth, billion-dollar deals, faster pace in this part of the year than they've ever seen in previous years, they're managing to just drive forward that this investment is really working for them. And Alphabet's been on a tear. It's up 45% so far this year, and it was near a record or at a record high. Why then are we punishing Meta and Microsoft, who have both said before we're going to raise capital expenditure, who have both been trying to articulate that AI is the destiny of choice? Mark Zuckerberg since 2023 has been saying 2024 is going to be the year that we're all in on AI, and we kept on congratulating him every time he sunk more money into artificial intelligence. Look, they got record revenue, 26% growth. What more did the market want? Perhaps a little bit more nuance on what revenue's really going to be looking like into 2026. We know that the next quarter is going to be growing, about 19% the market anticipates. But is that enough? Do they want to see a re-acceleration? Because here's a man, and indeed his CFO, Susan Lee, kind of saying, maybe we'll sell off our excess compute. If we build too much, we too can become a cloud provider, like an Amazon, like we've seen with Microsoft and indeed with Alphabet. Meanwhile, Microsoft does seem to be punished slightly less, but still, Amy Hood saying, my issue is supply, it's not demand, and I've got to keep reinvesting in this way. It feels a little bit like the market's fickle, and of course there was that big tax charge when it comes to the earnings per share for Meta, but I think they're moving that off. I think the bond sale's important.
We'll get to that in a second, but both Amy Hood and Mark Zuckerberg said basically we're investing as much as we can and we think it's enough, and every time we look at demand we realize it isn't.
Yes.
Right? We have to go more in terms of investment to meet that demand. On the other hand, Mark Muller from Bernstein asked, are we in a bubble here in terms of CapEx? Because you are seeing still incredible gains, right, in Azure, for example, but they're not any more than they were last year. So it's not commensurate with the increased investment.
Well, I think, and Amy Hood responded to that challenge by saying, my issue is supply. I'm not in an AI infrastructure bubble because, look, Microsoft's having to go to neo-cloud providers for its own AI compute work because they have so much demand for Azure itself. 39% growth in Azure was a really strong number and it beat market expectations. I think just on a dime we'll decide whether one day the market is worried about an AI bubble, the next it's not. Yesterday Bill Gates was articulating that maybe they're in an AI bubble. Sam Altman's already said that he thinks we are. Look, we've got the OpenAI chair talking. He's been also saying that maybe it would be good if we got a little bit of froth taken out of the market, but everyone's been so committed to thinking that these are your winners, the cloud providers, and the people who can really return money in terms of advertising product getting better. Meta saw revenues go up because its advertising market overall offering is so much more finessed with generative AI.
Right. I mean, don't forget the power providers, utilities, and the Caterpillars of the world that need to be there to build the data centers. But look, this is what price to perfection means, right?
Yes.
One day you have big gains, one day you have some losses. You mentioned the bond sale, and it's a huge one, right? Meta's looking to raise, what, $25 billion from the bond sale?
I mean, the only one that's been bigger this year is Mars when they're looking to make an acquisition. So we're looking at $25 billion. This really shows that they're having to get creative. They've done stuff off balance sheet, which they've done with Blue Owl, of course. They're building an enormous data center in Louisiana. It's going to cost a ton of money, but now they're raising money in the debt markets. But people want to be buying into AI-related debt at the moment. People have been able to sell gargantuan amounts. Oracle came and tapped the market to a significant demand. So I think that they're looking at, I think it just, the timing is a little brutal when you're thinking, oh my goodness, are we worried about this spending? Oh look, here goes their debt pile racking up a little bit. But then the bond sale just once again articulates that companies are having to spend this. But Mark Zuckerberg said this and done it before, actually. Trust me, let me build, and I'll go and make and reward you in terms of investment. And I think thus far, kind of everyone has to sit and wait and watch.
All right, Caroline Hyde, constantly in touch with the buy side and the sell side and the C-suite. We rely on you for your expertise. Thanks very much. And by the way, we're going to come back to Caroline a little bit later as she sits down with Bill McDermott from ServiceNow, one of the biggest gainers in today's market, at least in the pre-market. Let's get more of the tech picture. We're joined by Pierre Ferragu, New Street Research Global Team Head. of technology infrastructure. And Pierre, you have a buy rating with a $670 price target on Microsoft. What do you think about the idea that maybe we are in a tech bubble? On the other side, Amy Hood saying she really just is having trouble keeping up with demand.
Yes, that's a great question. And I think when you think about it, you don't want to oppose a bubble with a secular trend. And the answer to the question, are we a bubble, is of course, yes, we are in a bubble. When you have such like an inflection in demand for a new technology, at some point supply will exceed demand and you will have an adjustment and it's going to be more or less, painful, but we don't know at what level it's going to be. What we can say today is that Microsoft is building out, is renting out, and is sold out until the end of the next fiscal year. So it means we're still away from the top of the bubble. We are still in a situation in which Microsoft can increase a lot their capex. And as long as you see that on their P&L, their cash cost is actually not growing faster than their revenues, they are still in a very healthy build-up. So I think the reaction on the stock today is a natural, reaction of fear facing, the scale of what we are seeing. Like, can you imagine a business the size of Azure growing 40% a year? It's really we are living like in very unprecedented times. But the situation, I agree with the management of Microsoft, is still very healthy. That doesn't mean there won't be at some point a correction. There will eventually be. It's a necessity.
Well, that's what we were just talking about with Caroline Hyde, what price for perfection means, right? I mean, Mark Zuckerberg also was saying that he continues to spend aggressively. He continues to build out capacity as much as he can, thinking that will be enough, and then finding out that the demand is stronger. On the other hand, they don't really have the independent revenue streams at Meta that we can look at and analyze at Microsoft, that we can look at and see at Google, right? So it's a little bit more difficult for him to convince the street, and I guess that's why Facebook is getting decimated today in the pre-market.
Yeah, I think you exactly get it. It's much more difficult or unusual to read it on Meta. The way you want to read it is you look at how much capex are growing, how much it's increasing your DNA, your depreciation on your P&L, and how much you're growing your cash costs. And as long as your cash costs are not growing faster than your revenues, you are in a position where eventually this investment is going to pay off. The situation we are facing, though, with Facebook today is that they are guiding for next year an acceleration of their spending that basically makes their overall cost grow significantly faster than revenues. And from here, you really have two scenarios. Scenario number one is Facebook is being too fast and they're deploying capacity too early. And that means their capex is going to come down very significantly in 2027, 2028. And then their P&L is going to be restored. Or actually they have enough visibility on what they can do with AI to generate that growth where your revenues grow faster than your cash costs and generate the free cash flow you need to eventually pay off your capex. Remember that the capex is cash you spend today for a revenue stream that is going to last for years. So it's kind of okay to be in a free cash flow squeeze or even in a margin squeeze the year you accelerate on your capex, as long as you're going to be able to fill in these data centers. The good thing I would say is that spending too fast is not a big deal, because worst case, you slow down on your spending on the back of that to restore your economics. And the unit economics of Meta, you see them, the more capex they spend, the better their cash costs are in terms of efficiency. So the ratio cash cost on revenue is decreasing with capex increasing. So I think they're still in a very healthy place.
Pierre, our time with you really priceless amidst these massive earnings reports. So I really appreciate you joining us on Bloomberg TV, both today and yesterday, and I hope we can get you back soon as well. Pierre Ferragu there of New Street Research. He has a buy on Microsoft and neutral on Apple, which is, of course, coming out here after the bell. Let's take a look at some of the other movers on our radar. Chipotle getting crushed after cutting its full-year outlook for a third time this year. Traffic fell across all income classes, says the maker of delicious burritos. And nonetheless, the stock is down 20% in the pre-market. Also, Stellantis, the maker of my beloved Dodge Challenger, warned of one-time charges in the second half of the year due to political, economic, and regulatory pressures. It didn't provide specifics, but this is a company that investors still need to be sure about, with a brand new CEO in place after some really troubling times with Carlos Tavares. Now we have Antonio Filosa leading the ship, and today, unfortunately, those shares down almost 10% in the pre-market. Novo Nordisk offered to acquire obesity drug developer Metsera for at least $6.5 billion, which is higher than Pfizer's bid in September, and Pfizer called Novo's bid reckless. Now, the ECB decision is rolling out across the Bloomberg terminal. Let's get over to Bloomberg's Lizzy Burden. She's in Florence, Italy, this year's choice for the one policy meeting annually held away from the Frankfurt headquarters. Lizzy, what do we know?
Well, we are expecting a hold here, Matt, from the ECB for a third straight meeting. And they have said that they are determined to ensure that inflation stabilises at 2% in the midterm, inflation remaining close to the 2% target. As you would expect, they're sticking to this data-dependent, meeting-by-meeting approach. A hold is what was expected here, given that they've got inflation almost at target. GDP this morning beating expectations across the euro area economy. And so this is what they have done. They've held rates at 2%. It was unanimously expected by economists, fully priced in by markets. And indeed, this is what economists expect they are going to do for the next 2 years. Despite the trade turmoil, despite the turmoil in French politics, euro area economy in a good place, according to Christine Lagarde. So I would expect in the press conference that she keeps up with this data-dependent meeting-by-meeting approach. They're extremely divided on the Governing Council right now as to what the next move should be when it eventually comes. Some saying they need to keep their powder dry in case they need to cut again. Some saying that they may need to hike. But in terms of the market reaction, Matt, euro dollar pretty steady off the back of this. Weaker 0.4% at 115. That's exactly pretty much where it was before the decision.
All right, Lizzy Burden, thanks very much. Lizzy Burden there, not in Frankfurt, which I'm sure to her is a great relief, rather in Florence, Italy. And stay tuned, by the way, we're going to go back to Lizzy. We're going to go back to Florence because ECB President Christine Lagarde is holding a news conference in just under 30 minutes. And, you know, right before the decision, we saw the euro drop to the lowest level that we've seen since, I believe, July of this year. So dropping down to basically 116 and a half there. And we'll continue, dropping down now to 115 and a half is what I should have said. We'll continue to keep our eye on that. Joining us at the desk here is Lauren Goodwin, economist and chief market strategist at New York Life Investments. And you know, with the Fed yesterday and the ECB today, a lot to talk about around central banks. Finally, we get real dissent at the Fed. Do you think that's expected to continue?
I do expect that that will continue because, frankly, there's a lot to disagree about. This is a really uncertain economic environment, putting aside the data that we do or don't have. Moving forward, the range of policy changes that have happened in the last 6 months and their impact on the labor market and inflation, there's a lot to be confused about. And so I anticipate that we'll continue to see folks that are saying, look, growth is expected to potentially reaccelerate in the new year. Inflation is not moving lower, against others that say, given the global pressures that we're seeing, et cetera, we should expect the labor market to continue to see some challenges. We're going to see dissents.
In terms of the path forward, is it still lower, though? I mean, inflation doesn't seem to be a real worry for the Fed. They feel okay, it seems like, with 3%.
They do seem okay relative to what we're seeing in the labor market, which is a very clear weakening, not just of supply, but
which is still, for my lifetime, Lauren, 4.3% is an incredibly low unemployment rate.
It's a low unemployment rate, but we are let me take a step back, actually. When you think about these major moments in sort of economic regime change, go back to the mid-90s when you had technological change, a big push in globalization. You have central banks sort of looking at the zeitgeist and saying, where do we really think the economy is going? And I think that's a moment that the Fed is facing right now as well. You have major investment in AI, which could impact the labor market in a meaningful way. But you also have a deglobalization environment that's putting pressure on, upward pressure on investment, upward pressure on inflation, potentially moving forward. These are big secular changes that they're having to sort of navigate, and they're both real. And so even with the absence of data, sort of parsing out what that looks like and almost trying to take a stand on what the next 5 years looks like and what monetary policy needs as a result, it's a big challenge.
AI seems like a double-edged sword. We've talked to a number of private equity, masters of the universe recently, and they've told us that their portfolio companies, they're seeing maybe to some extent a reduction in hiring because they can replace jobs with AI. On the other hand, they see a huge demand for skilled labor. And I'm from Columbus, Ohio, where Intel is supposed to be putting in a $30 billion fab. Jobs have increased around that project, right? So you need to build these things. People are going to use them, I guess, providing revenue. On the other hand, it's going to replace jobs. How do you see that affecting the labor force?
I think there's an element of timing here. I'm seeing across the CEOs and asset managers that we're speaking with, portfolio companies, et cetera, a real hesitance to lean into hiring at this moment because could AI tools help us to bring some efficiency into given roles? And also, don't forget that for many businesses, the economic environment's still pretty uncertain. Knowing exactly what demand looks like into the first half of next year is a difficult call to make. So we're seeing a no hire, no fire market, labor market that so many in the investment zeitgeist are talking about. If I fast forward a year or 2 years, right now, we have only just started scratching the surface of the application layer of this technology. I think probably the best example of what this might look like for the labor market is probably more like Microsoft Excel than like robotics. When Microsoft Excel becomes a tool that everyone can use, you don't need bookkeepers anymore, writing down on paper, et cetera. Instead, you create an entire new role of financial analyst that changes enormously what companies can look at and what we can do. I think that's what we should expect with AI.
You studied at USC, pretty good school. Then you went to Johns Hopkins. We love that here, right? Didn't you learn about new technologies in the past where economists, your forebears were warning, like, this printing press is going to destroy all the jobs, or the internet's going to kill the labor market? And every single time, it doesn't happen.
I love thinking about past economists as my forebears, the forefathers of the system. I think that's
standing on the shoulders of giants. Right?
I think that's exactly right. This technology is likely to enable productivity in a meaningful way. We will need different types of jobs than we need now, but our stance on sort of the 5-10-year outlook for the labor market is that you need new types of jobs, not that you don't need the labor. And that's not to forget that some of the areas where we're seeing the most pressure, at least here in the U.S., when it comes to sort of wages and demand, are the jobs that computers and even robots can't do. It's restaurant jobs, it's hospitality. These are challenging jobs for robotics to fill.
All right, Lauren Goodwin is going to stay with me through the open as more earnings continue to roll in. A lot moving in these markets. We get the C-Suite view of earnings as well. ServiceNow CEO Bill McDermott will discuss how AI has helped his firm cut spending with Caroline Hyde. This is a packed edition of Bloomberg Open Interest. Quick check on futures as we approach the opening bell. And I will note also in the cash trade yesterday, we closed at 68.90 for the second day in a row. So we were up in the morning, we came down at the end of the day, but then nothing changed. Right now you see that the S&P futures are down 0.4%. NASDAQ futures are down a little bit more as Microsoft gets taken down and Meta gets decimated. Let's take a look at some of the movers on our radar. eBay issued a weak profit outlook for the holidays, adding to concerns around margins heading into the busy shopping season. Roblox reported its best quarter to date as more players than ever spent money on the platform. Roblox down today, but it's up 130% year to date. And Starbucks returned to sales growth for the first time since 2023, but shares are down as investors scrutinize its costly turnaround plan. And I heard the coffee tastes kind of burnt. We're going to be right back with the opening bell. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on futures. Right now, we are down, but of course, we're hovering at all-time highs. Yesterday, even though we closed off 1/3 of 1%, we still closed at 68.90. So that is at a record high. We just opened higher than the close of the day before. So futures down about 0.5% on the S&P and the NASDAQ, a little bit more on the Russell 2000. Here, the opening bell down at the New York Stock Exchange, the Fortune Cyber 60 ringing the bell there. It's an appropriate day for that. Down at the NASDAQ, you have Solstice ringing the opening bell. Look, Mark Cudmore had a great piece out today. Stop kidding yourself. Nothing else matters beyond AI. So let's take a look at those stocks right now. The big mega cap tech stocks. Meta Platforms in the cash trade down almost 12%. So Mark Zuckerberg coming out and saying, no matter how much I spend, it's never enough. And next year is going to be more. Investors are a little bit concerned about that, obviously. Microsoft down just 2%. Amy Hood, the CFO at Microsoft, also saying, like, I can't get enough supply. We have to spend more. Alphabet shares are up right now because more people are using Google Gemini. I think 44% more in the last 3 months alone. So it's really the winner in terms of momentum. Of course, it hasn't eclipsed ChatGPT yet, but they're also growing the cloud in a massive way, like 34% in terms of cloud revenue. Apple, after the bell, we're going to get the results there, and we're all waiting with bated breath. Right now, it's up 1 1/3%. For more on the tech picture, we're joined by Bloomberg tech co-host Ed Ludlow. And Ed, we were talking with Caroline Hyde about how spending just continues to ramp up, and although cloud revenue rises, it's just not a commensurate gain.
Yeah, but look at the number that's green on your screen, right? Alphabet. So what we got from all of the names was capital expenditures figures. In the brinkmanship between Wall Street's nervousness on seeing a return on the capex and the company's commitment saying this is our capex, only Alphabet gave us any kind of further number, and that is that they said that the revenues from products directly tied to the investments in generative AI were up 200% from a year earlier. Otherwise, the investors don't have anything to model for, right, on what the return is coming out the other side.
Yeah, no, that makes sense. And for Facebook, it's especially difficult because, I mean, Caroline Hyde was just telling me that they apparently have an AI app. I didn't realize that. I use, obviously, ChatGPT. I use Google Gemini. But there's no single revenue line item at Facebook that you could point to and say, see, it's working.
Correct. And Meta didn't formally guide us on that for the next fiscal year. They just indicated that on the capital expenditures side, it would be notably higher than the $72 billion at the top end for this fiscal year. Meta's decline of 12%, by the way, puts it on track for its biggest drop since the end of 2022 on a closing basis. So, this is severe. But on the other hand, Meta is not a hyperscaler, Matt. One of the things to understand about it, beyond investors having some kind of top-line growth guide, is that all of the investments Meta is making is also to give capacity to its teams internally. Advertising is still its bread and butter, but when they have new data center capacity that comes on that's used for training AI models or running it, they have competition from their own teams who all go to the CFO and the other executives and say, we need that capacity to make this ad product better or more effective or monetize it better. And that's a problem that's unique to them that the hyperscalers don't have to deal with necessarily.
I mentioned Mark Cudmore's piece that AI is the only theme that matters.
Yeah.
That's maybe overstating the case a little because trade does matter, and Apple's coming out with earnings after the bell. What do we expect from the big device maker?
Yeah, the first $100 billion September quarter, so that could be notable. The soft or third-party data indicates that the iPhone 17 generation is tracking ahead of the prior generation in early sales. The quarter they're reporting will include 2 weeks where the iPhone 17 generation was on sale. And there is a caution. There have been years where the soft or third-party data says it's doing badly, and then Apple's earnings come around and give us the complete opposite picture. So it can go both ways. But Apple has also communicated in the last 2 quarters their expectation for tariff impact. And actually, it was mitigated. It was not as bad as they first guided us on. But that will be a factor in it. Just as we've learned this earnings season, a tax issue was a factor on net income for Meta. and it was for Netflix in its tax dispute with Brazil. So idiosyncratic things come up all the time. But for Apple, it's a simple story. Did the iPhone 17 do well or not in the 2 weeks it was on sale, in the quarter they're going to report? And then all the big picture questions for Apple are always there, and they haven't changed.
All right, Ed, thanks very much. Really looking forward to your program today. Ed Ludlow, co-host Bloomberg Tech, that kicks off in an hour and 25 minutes. Let's bring back New York Life Investments economist and chief market strategist Lauren Goodwin. And you're not just an economist, you are a chief market strategist there as well. What should investors be buying right now? You know, investors who already own NVIDIA, who already own Microsoft, who already own Google.
I think what we're seeing in the market right now is a shift from what was even just a week or two ago, a focus on sort of climbing the wall of worry. It's now just tailwinds at their back. Trade, the Fed, earnings, all looking very positive. And so while we're very constructive on the market, I do anticipate that we're going to see wobbles over the next couple of quarters. In that context, you have to be invested in U.S. large cap tech. Like, this is maybe not the only theme that matters, but obviously one of the clearly most important themes involved in this market. And then the rest of your portfolio construction for a U.S. and ex-U.S. investor has to do with what you build around that. We are seeing U.S. investors close underweights to international equity, including Europe and Japan, because of the different sector promise. We are much more excited about private equity for sort of smaller company exposure because we see better profitability there. With the Fed cutting rates, we see spreads potentially even tightening from here, and so we've been pretty bullish on short duration credit. I know. It's all about, as boring as it sounds, diversification, which until the last couple of months, investors haven't been taking seriously because U.S. Tech has been so dominant.
How much do you allocate to, you know, mega cap tech, hyperscalers, and then to like power gen or, you know, earth moving equipment? You know, because these things are also incredibly necessary. I don't understand how we're supposed to meet the power needs, and I don't think Mark Zuckerberg or Sam Altman do either.
I think that's right. Power gen is going to be an incredibly important element of the sort of next, let's say, building out the infrastructure layer in the next stage of AI investment. Here's what I'm concerned about over allocating to these spaces. Two things. First, they tend to be more interest rate sensitive, and with electricity prices moving higher, that is one of our calls for a sort of catalyst for a blip, let's say, a short-term pullback in the market. And we expect that those equities would be most impacted. So we are benchmark weight to utilities, energy, et cetera, but not overweight. The second reason why we're staying there is that these energy sort of, let's say, speculative energy opportunities, the sort of build out of the nuclear power base, et cetera, I believe will be an important part of the future story. But that's where we're seeing the most investment with the least earnings.
What else do you like? I mean, defense was supposed to be a huge play, and Europe is spending, everyone seems to be spending more outside the U.S. on defense, but you didn't see a huge takeoff in, you know, weapons makers.
Yeah, not yet. I think a part of that is that, and related to the challenge that we're seeing for the ECB, who of course just had their decision this morning, is that the sort of impetus of infrastructure and defense spending supporting the European economy is probably going to be slower than investors have anticipated. I think it's still there. I think it still matters. And in the context of a broader geopolitical frame where we are staying overweight to gold, having energy and even digital currency exposure as a component of the sort of de-dollarization trend, these are very long-term trends. And so if you're looking for the quick hit from the market, that's probably not it, defense included, but something that we anticipate to bring some bolstering for a portfolio in 2026.
Lauren, awesome to spend time with you. Thank you so much for coming in. Lauren Goodwin there is the chief economist and chief market strategist at New York Life Investments. Now, some of the movers on our radar include drug makers Merck, for example, trimmed sales guidance as growth for its main drug, Keytruda, failed to meet estimates. Eli Lilly boosted its revenue forecast as sales of Zepbound nearly tripled after price drops. That's obviously the weight loss drug that rivals Wegovy and Ozempic. Novo Nordisk offered, speaking of, to acquire obesity drug developer Metsera for at least $6.5 billion. It's a higher bid than Pfizer's agreed bid in September. And, well, Novo calls it superior. Pfizer calls it reckless. Let's discuss with Bloomberg health reporter Madison Muller. She joins me here at the desk. And this bidding war is getting pretty hot. I mean, I don't think I've ever heard one bidder call another bidder reckless. What do they mean?
Yeah, it's definitely intense. This morning, it's been some juicy drama in the pharma world amid lots of pharma earnings, so there's lots going on. But Pfizer, as we've talked about, really has wanted to get into obesity for a long time. Obviously, it's a red-hot market. They are a huge drug maker in the United States, and they are sort of one of the ones that are not in this market right now. It's really dominated by Eli Lilly and Novo Nordisk. So Metsera is one of the obesity startups that's trying to develop a next-generation drug, potentially easier to take, gentler on the stomach. You know, we've talked about these drugs have side effects like nausea and vomiting. And so it's created a bit of a...
How much do you
a bidding war now.
Having to say nausea and vomiting all the time?
It's better than diarrhea.
I was reading that in your copy. Okay, that's a very good point. I'm surprised that Lilly is doing so well, considering how difficult it is for patients to access Zepbound. I spent a lot of time on the Reddit forums, and they all say they've been kicked off of Zepbound because like CVS doesn't offer it or whatever, and now they have to go to Wegovy or Ozempic. Is that not a problem?
It definitely is a problem, and that's a good point. And Lilly's management had actually said last quarter that they expected that decision, which there was a deal between Novo Nordisk and CVS's drug benefits unit to sort of prefer Wegovy over Zepbound, ended up kicking some patients off of Zepbound. Lilly had expected that to weigh on their third quarter sales, but at least, I mean, maybe it did. Maybe the numbers would have been higher, but they still beat estimates. They still, I mean, more than like doubled growth from last year in terms of Zepbound and Mounjaro. So even if there was an impact, Lilly is still really soaring, and these drugs are still doing really well.
All right, it's a story we're going to continue, obviously, to talk about. I'm down 20 pounds.
Oh.
Madison, thank you so much for joining us. Madison Muller covers healthcare for us. Two other stocks to watch, Chipotle and Starbucks. Chipotle cut its outlook for a third time this year as it saw traffic fall across all income levels. Starbucks reported actually positive same-store sales growth for the first time in nearly 2 years, and yet the shares are off 1.5%. Bloomberg's Red Brown is here to explain. He analyzes the earnings for us here at Bloomberg. Let's start with Chipotle getting absolutely clobbered.
Yeah.
A concern about the consumer, and I would guess also if you're using Eli Lilly's Zepbound, you're probably less likely to go get a carnitas burrito with extra sour cream.
It is a lot of food. But I think for Chipotle right now, they're in a tough spot, right? Because they are having difficulty kind of explaining the value proposition of a Chipotle bowl. It is a lot of food, right? And it's only around like $10, $12 most of the time, even here in New York City where prices tend to be higher. But at the same time, people still aren't coming in to have, to enjoy a Chipotle. It seems like there's still kind of this like value misconception around the product, and the company's having a lot of trouble with that, and it also kind of constrains them in terms of raising price. So at the same time, they are dealing with higher beef costs, higher food costs, a little bit higher kind of than some of the what we're hearing from some of their competitors as well. So that also kind of reins in how much they can raise their prices. If we want to raise our profits, we want to become more profitable, but we're not able to do that because we can't scare off the consumers that are already sort of running away.
What's wrong with Starbucks? They come out and show this turnaround. Brian Niccol seems to be doing all the right things now, and yet the shares react negatively. Is this like a buy the rumor, sell the news kind of story?
I mean, it's one quarter, right? So it is, I think, it's a kind of the first shred of news that we can kind of positively point to saying, like, yes, turnaround is working, right? But it's one quarter. The other thing to keep in mind is that they didn't give outlook. Typically, that's what you will get in a fourth quarter earnings, is you will get an outlook for the company. So it's like, how much can we really read into these results if we're only getting one quarter of positive results, where you're not able to give us a full outlook quite yet? So that is expected to come in in January, late January, do an investor day. So we'll get a little bit more information about how the turnaround is taking hold or not.
All right, shares down 12%. That's total return over the last year. If you look at just the price change, it's more than 14%. off in the last 12 months. Red, thanks so much for joining us. Bloomberg's Red Brown, as he said, wait, did you say, or was that my producer saying in my ear? I can't remember. Brian Niccol is going to join us today on Bloomberg Television. That interview on the close at 3 p.m. He is, of course, the CEO of Starbucks, and that's one that you don't want to miss, obviously, if you're invested or if you just like coffee. ECB President Christine Lagarde's news conference just moments away, this time in Florence, Italy. Let's go to Lizzy Burden, who is lucky enough to be on the ground there. Lizzy, what do we expect from Madame Lagarde?
Well, Matt, we have just had a hold from the ECB as expected. They're really hoping for a Goldilocks scenario here where the trade weakness is offset by that German fiscal stimulus. I've been flicking through the guidance as we ramp up to this press conference. They're optimistic on growth, but they do say that the outlook remains uncertain when it comes to trade and geopolitics. They say that the inflation outlook is broadly unchanged. And as expected, they've said they're not pre-committing to a particular rate path. That's the language I expect Lagarde will be using in the press conference. They've added that decisions in future are going to be based on the inflation outlook and risks around it. So really putting the spotlight on the updated forecasts that we'll get in December. But so far, this has not been market moving, even if the market is still very much biased towards easing in the future, even if the Governing Council is really so divided on the direction of the path ahead. I'm not expecting fireworks from this press conference in Florence. I'm sorry to disappoint you, Matt. And I have to say, it is a much calmer time than the last time the Bank of Italy hosted the ECB for its on-the-road annual meeting. The last time, you'll remember, Mario Draghi was in the hot seat. They had protests outside. This time, as Madame Lagarde has said repeatedly, the ECB and the euro area economy in a much better, a good place.
All right, Lizzy Burden there reporting from Florence. And we did see, Lizzy, the euro touch the lowest level since July. You mentioned, you know, the inflation outlook. They're pretty much there on headline, right, at 2%, a little bit higher on the core, but they have that coming down over the next couple of years. What does Lagarde need to see in order to cut at the next meeting? They've been on hold for 3 meetings in a row.
Well, as I say, I really think the focus is going to be on those December forecasts, the outlook over the next couple of years, the medium-term outlook. They've said in the commentary already that they're really focused on stabilising inflation at 2% here. So they'll be looking for that to happen. Of course, they've got to factor in the trade, the French politics as well, and the fiscal uncertainty there, and the general geopolitical uncertainty around the world. But this is what Lagarde is going to be talking about in the press conference. I'm sure she might also be asked about the digital euro, because they've had a report out on that today. We're at the end of the 2-year phase of prep on that. The launch date was supposed to be in 29, but there's been such division across the euro area about whether they should bring it in. The backdrop, of course, dollar weakness and Lagarde touting the role of the euro against the dollar. So that will probably be an issue that comes up in the press conference. But as you say, what everybody wants to know is the direction of rates at the next move, whenever that may come. At the moment, economists think it's still 2 years away, but some on the Governing Council, the likes of the French central bank governor, saying they need to keep their powder dry, maybe for another cut. Hawks, like the Austrians, saying the next move could be a hike. So we'll listen closely to this press conference. All
right, very interesting stuff. I mean, they have growth forecast out at, I don't think, a lot more than 1.3% over the next couple of years. We just saw Christine Lagarde walk out with her team there in Florence, Italy. Remember, once a year they hold a meeting somewhere outside of Frankfurt. I was lucky enough to go to Estonia for one of those, but I think Florence is probably, well, I don't want to say more interesting, but maybe a more famous place. Let's listen in to what the ECB Governing Council has to say.
As you know, the ECB Governing Council meets once a year outside Frankfurt as part of its tradition of strengthening ties with euro area countries and highlighting the truly European nature of our institution. After Rome, Venice and Naples, this is the 4th time Italy has the pleasure of organizing the meeting of the Governing Council. Over to you, Wolfgang.
Thank you, Governor Panetta. And there's also on stage President Lagarde and Vice President de Guindos. and my name is Wolfgang Preußel. We have participants online, so if somebody takes the question via video, I ask you to turn on the camera and the microphones, and with that, I hand over to President Lagarde, please.
Grazie mille. Thank you, Wolfgang. Good afternoon to all of you. The Vice President and I welcome you to our press conference. I would like to thank Governor Panetta for the kind hospitality he offered and express our special gratitude to all his staff for the excellent organization of today's meeting of the Governing Council. The Governing Council today decided to keep the 3 key ECB interest rates unchanged. Inflation remains close to our 2% medium-term target, and our assessment of the inflation outlook is broadly unchanged. The economy has continued to grow despite the challenging global environment. The robust labour market, solid private sector balance sheets, and our past interest rate cuts remain important sources of resilience. However, the outlook is still uncertain, owing particularly to ongoing global trade disputes and geopolitical tensions. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to any particular rate path. The decisions taken today are set out in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and we will then explain our assessment of financial and monetary conditions. The economy grew by 0.2% in the third quarter of the year, according to Eurostat's preliminary flash estimates published today. The services sector continued to grow, boosted by strong tourism and especially by a pickup in digital services. According to surveys, the pickup reflects the fact that many firms have stepped up efforts to modernize their IT infrastructure and integrate artificial intelligence into their operations. Meanwhile, manufacturing was held back by higher tariffs, still heightened uncertainty, and a stronger euro. The divergence between domestic and external demand is likely to persist in the near term. The economy should benefit from consumers spending more as real incomes rise. Unemployment at 6.3% in September remains close to its historical low, even though demand for labor has cooled. Households continue to save an unusually large proportion of their incomes, which should give them greater margin to increase spending further. Substantial government expenditure on infrastructure and defense, as well as our past interest rate cuts, should underpin investment. By contrast, the global environment is likely to remain a drag. Goods exports declined from March to August, reversing the earlier front-loading of international trade ahead of recent tariff increases. New export orders in manufacturing point to further declines. The full impact of higher tariffs on euro area exports and manufacturing investment will only become visible over time. The Governing Council stresses the urgent need to strengthen the euro area and its economy in the present geopolitical environment. And we welcome European Union leaders reaffirming this ambition at last week's Euro Summit. Fiscal and structural policies should boost productivity, competitiveness and resilience. It is essential to implement the European Commission's competitiveness roadmap swiftly. Governments should prioritise growth-enhancing structural reforms and strategic investment while ensuring sustainable public finances. It is also vital to foster further capital market integration by completing the Savings and Investments Union and the Banking Union to an ambitious timetable, and to rapidly adopt the regulation on the establishment of the digital euro. The Governing Council is committed to making retail and wholesale central bank money fit for the digital age. In this vein, the Governing Council today decided to move to the next stage of the digital euro project. This will ensure technical readiness for potential issuance and support Europe's digital sovereignty once legislation has been adopted. The details of this decision are available in a separate press release. Looking at inflation now. Annual inflation increased to 2.2% in September, from 2% in August. This was mainly because energy prices fell by less than before. Energy price inflation was minus 0.4% in September, up from minus 2% in August. Meanwhile, food price inflation eased to 3% in September, from 3.2% in August. Inflation excluding energy and food rose to 2.4% from 2.3% in August, as services inflation ticked up from 3.1% to 3.2%, while goods inflation was again unchanged at 0.8%. Indicators of underlying inflation remain consistent with our 2% medium-term target. While firms' profits are recovering, labour costs are set to moderate further owing to rising productivity and an easing in wage growth. Forward-looking indicators, such as the ECB's wage tracker and surveys on wage expectations, point to slower wage growth over the remainder of the year and the first half of 2026. Most measures of longer-term inflation expectations continue to stand at around 2%, supporting the stabilization of inflation around our target. Looking at risks now. The EU-US trade deal reached over the summer, the recently announced ceasefire in the Middle East, and today's announcement of progress in the US-China trade negotiations have mitigated some of the downside risks to economic growth. At the same time, the still volatile global trade environment could disrupt supply chains, further dampen exports, and weigh on consumption and investment. A deterioration in financial market sentiment could lead to tighter financing conditions, greater risk aversion, and weaker growth. Geopolitical tensions, in particular Russia's unjustified war against Ukraine, remain a major source of uncertainty. By contrast, higher than expected defense and infrastructure spending, together with productivity-enhancing reforms, would add to growth. An improvement in business confidence could stimulate private investment. Sentiment could also be lifted and activity spurred if the remaining geopolitical tensions diminished, or if the remaining trade disputes were resolved faster than expected. The outlook for inflation continues to be more uncertain than usual on account of the still volatile global trade policy environment. A stronger euro could bring down inflation further than expected. In addition, inflation could turn out to be lower if higher tariffs lead to lower demand for euro area exports and induce countries with overcapacity to further increase their exports to the euro area. An increase in volatility and risk aversion in financial markets could weigh on domestic demand and thereby also lower inflation. By contrast, inflation could turn out to be higher if a fragmentation of global supply chains pushed up import prices, curtailed the supply of critical raw materials, and added to capacity constraints in the domestic economy. A boost in defense and infrastructure spending could also raise inflation over the medium term. Extreme weather events and the unfolding climate and nature crisis, more broadly, could drive up food prices by more than expected. Turning to financial and monetary conditions, since our last meeting, market rates have remained broadly unchanged. Our past interest rate cuts have continued to reduce bank lending rates for firms, which average 3.5% in August. Meanwhile, the cost of issuing market-based debt remained at 3.5% in August, as the longer-term yields on which such debt is priced have been relatively stable. The annual growth rate of bank lending to firms edged down to 2.9% in September from 3% in August. At the same time, corporate bond issuance slowed to 3.3% on a yearly basis. According to our latest bank lending survey for the euro area, credit standards for business loans tightened moderately in the third quarter, as banks became more concerned about the risks faced by their customers. Firms' demand for credit picked up slightly. The average interest rate on new mortgages has barely changed since the start of the year and stood at 3.3% in August. Growth in mortgage lending ticked up to 2.6% in September from 2.5% in August on the back of a further increase in demand and unchanged credit standards in the third quarter. Growth in broad money, as measured by M3, slowed to 2.8% in September, down from 2.9% over the first half of in August, and an average of 3.8% over the first half of the year. So, in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. And we are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions. Thank you.
President Lagarde, thank you very much for taking my questions. First question would be, of course, on your famous mantra that you're in a good place right now when it comes to the policy stance. So given that private economic activity in the euro area is not really great, would you say that...
It's not really what?
Not really great. I mean, if you deduct what comes from the fiscal space, then the economic picture doesn't look so great. So would you say that your policy stance is in a right space if that private economic activity is not picking up? Second question would be on AI and the ramification for the labor market. We've heard from from the Fed President Jerome Powell that he looks very carefully at what AI does to the US labor market. It probably takes a while until this hits here as well, your area, but what do you think, and do you have discussion on that topic? Thank you.
Thank you very much for your two questions. Your first question, are we in a good place? I would observe that thanks to the hospitality of Banca d'Italia, we are in a magnificent place, okay? From a monetary policy point of view, we are in a good place. Is it a fixed good place? No, but we will do whatever is needed to make sure that we stay in a good place. And I would observe that with growth of 0.2% for Q3, which is a tad more than what was expected by the consensus, and including Ireland a little more than what we had expected, not by much, I would not complain too much about growth at this point in time. We can do better, we hope it's better. I observe that there is quite a bit of investment underlying this number, certainly in respect of France, which publishes breakdown. So turning to your other question, which has to do with artificial intelligence, what we are hearing from the corporate telephone surveys in particular that we conduct on a regular basis is that corporate is really moving ahead with investment. And the transition to a more digital world is obviously on their mind, and it's also drawing on the investment that they are committing now. So this is a process, and the impact it will have on labor will probably take time, and we will be very attentive to those developments. There will be job creation, there will be job destruction. How exactly that will impact our economies, depending on the sectors, depending on the classes of age, depending on the training, depending on the educational background of workforce in Europe, which is generally, which tends to be quite high, I think is to be seen, but we will be attentive to those developments. Thank you.
Next question goes to Jana Rando of Bloomberg. Jana, please.
Good afternoon. Thank you very much. I have a question following up on your comment that we are in a good but yet not yet or not fixed place on policy. You have held rates 3 times now, and I am wondering if you are or would be confident to say that a rate cut is as likely as a rate hike sometime in the future. And my second question is about risks. You listed quite a few upside and downside risks for both growth and inflation, but I noticed that you didn't speak about a balance. So I'm very interested in hearing your thoughts on whether at least the risks for growth are broadly balanced or more balanced than they used to be, and on inflation as well, of course. Thank you.
Thank you. Thank you very much for these 2 questions. You know, I have said that we are in a good place. I continue to say that we are in a good place. And I repeat that we will take the necessary measures and steps on the basis of data, meeting by meeting, to make sure that we stay in a good place. On your second question, which has to do with the, and I also want to remind you that we have very clearly defined our objective. And that objective is, because you asked me the question about symmetry, our target is symmetric 2% medium term. And we will abide by that objective that we have discussed extensively in 21, reiterated in our 21 strategy review, and reiterated again in 25 when we took stock of our strategy implementation and the stock-taking exercise. On the risk, you are right, because when you go to the section of our monetary policy statement, we list as exhaustively and yet as principally as is possible the number of risks on the downside and on the upside. But what is a little bit different this time around is that our paragraph on risk assessment begins with indicating some of the risks which have faded or have been alleviated in the last few weeks, and it starts with and the impact that it has had in particular. So we start with the EU-US trade deal reached over the summer. We follow with the recently announced ceasefire in the Middle East, and we continue with the announcement today, this morning actually, of progress in the US-China trade negotiations. And we continue with these components have mitigated some of the downside risk to economic growth. So if you remember last time in September, I said that the risk to growth was more balanced and the range had narrowed. I think this time around we acknowledge that some of the downside risks to growth have abated, and we specifically mentioned these three. I would not necessarily draw the same conclusion for inflation. I think on that front it's a more balanced picture that we paint, and we go through the upside and the downside risk to inflation, and I would suggest that we remain attentive to the occurrence or the risk of occurrence of any of these risks that can weigh on our inflation. Thank you.
And the next question goes to Francesco Canepa of Reuters. Francesco, please.
So I'm just following up on Jana's question. So what you just said about downside risks to growth abating would suggest that perhaps there was a discussion about changing the balance of risks to say that the risks have perhaps turned to the upside. Was there any such discussion, and why did you not kind of follow through on what you just said in terms of the downside risks to growth abating, or some of them at least? Well, the second question perhaps to Governor Panetta about Italian banks. Italian banks are making great use of state guarantees when they extend loans. This has also helped them make relatively large profits, and the government sometimes decides to take some of those profits with one-off levies. So what are the implications for financial stability and for public finances of this merry-go-round sort of scheme where the government guarantees loans, but then it takes a stake in the profits? Thank you very much.
So I'll address your first question. You remember that last time we referred neither to downside nor to upside, but we said that the balance of risks had, or the range of risks had narrowed. And once you've said that, and you said that it is more balanced than it was, you cannot repeat ad nauseum that it is more balanced and more balanced each and every time, which is the reason why we chose to list specifically risk to the downside, risk to the upside, and we acknowledge in the first part of that risk section concerning activity that some of the downside risks that we had with us for quite a while had abated. And I think there was some discussion, as always, on the one hand, on the other hand, some see a little bit more of this, a little bit more of that, but I think we were all in agreement on that identification of risk with a specific listing of those risks. We are in a period of still great uncertainty, and many of those risks are resulting from policies and implementation of policies. So I think that's the best that I can give you in terms of explaining to you why we do not draw a line on, it is one way or the other, and prefer to list those risks carefully.
Thank you for your questions. You are absolutely right. Italian banks are highly profitable. Their profitability conditions have improved significantly in the last few years, and this was due to many factors. I would say that the main one is the restructuring of the banking system, which took place over the last 10 years after the financial crisis. You know that Italy went through a complicated period in the mid-2010s, but the banks that resulted from that phase are highly profitable, much more capitalized, and much more efficient. So their improvement is due to many factors, not just to the support that they got from the government, as many other banks in Europe. On the impact, no, it will not have any financial stability implications. We will not have financial instability because of the tax. The banks are highly profitable, and the tax is a limited percentage of their profits. On the specific characteristics of the tax, I will comment when I will see the final text of the legislation.
And now a question to Filippo Santelli of La Repubblica here in the second row.
Thanks for taking my question. I have two questions on the digital euro. The first to President Lagarde. One of the objections of the criticism towards the project, which, by the way, was raised also by the rapporteur of the regulation in the European Parliament, is that the digital euro is a solution in search of a problem. And its objective might be better realized through market-led solution and maybe helped by a smarter regulation. How do you respond to that criticism? And the second one to Governor Panetta. Banks around Europe, including Italian banks, have warned about the costs of adopting the digital euro, even suggesting that their costs could be higher than ECB estimates, as it's sometimes the case with public infrastructures. Is the euro system considered an option to lower those costs, and are you afraid banks might pass down those costs to the consumers? Thanks.
Thank you very much for your question. For me, as president of the ECB, I regard money as a public good. Money is a public good, full stop. And that public good, for many, many decades, has been built around central bank money, which is the anchor on which commercial money, which is created by banks, prospers and develops. But the anchor is critically important in order to make sure that money remains a public good. So in our mind, and certainly in my mind, central bank money has to remain an active part of the system that people can actually trust. If you think of digital euro, it's the digital form of a banknote. People need to have their banknote. Maybe in 10 years' time, there will be fewer of those banknotes in circulation, but they will still need to have the certainty that a euro is a euro is a euro, just like a rose is a rose is a rose. And for me, it is our mission to make sure that money remains that public good that is available to our compatriots. And we are working for the Europeans in that respect. When I hear that it's a project in search of a cause, I think that money as a public good, the sovereignty of the European authorities at large over their currency and the way in which money stands, this is not a project in search of a cause. It embodies the capacity of Europe to defend itself and to transact with a currency that is its own. There are many other reasons why the digital euro is perfectly legitimate, valid, and will be cheaper, user-friendly, good for transaction throughout Europe and not just in various countries on a national basis. But the key points for me is money is a public good, central banks are the custodian of that public good, and central money issued by central banks has to have its digital form, because we're moving into a different era where not everybody will want necessarily to have banknotes. Thank you.
Well, you did not ask me, but I will, before I answer your question, I want to say that I strongly agree with what the President just said. We need public money for the stability of the financial system. So the President is, as always, absolutely right. On the costs, I think it would be unwise to discuss costs before discussing the benefits. Currently, euro area banks only represent 1/3 of total activity on digital payments in the euro area. 2/3 of digital payments in the euro area are intermediated by non-European companies, both for digital payments at the point of sale and digital payments online. Now, the reason why this is so is that the European Bank did not agree until now on ways to provide their services to the entire euro area. They don't have what is called in technical terms a rail, the infrastructure to provide, to offer their digital payment services to all European citizens. One of the main benefits, advantages for banks, there are many benefits for consumers, there are benefits for the stability of the financial system. One of the main benefits for the banks in the euro area is that once the digital euro infrastructure will be built, they will be able, by using this so-called open standard infrastructure, to use that rail and compete at European level, thus generating additional business, additional revenues. And there will be many implications in terms of sovereignty for the euro area, in terms of control of the information that travels with your payments. This is the first part of my comment. The second, the costs. Now, there are estimates on the cost of adoption, because the construction of the digital euro will be paid by the euro system. Okay? The cost, I don't know if the estimates which are available are correct, discussed numbers of about 6 billion euros for 4 years. Now, if you think that we have 2,000 banks in the euro area for 4 years, this means that the cost of adoption is a few €100,000 per year per bank. Now, even forgetting the benefits I just mentioned, then the costs of adoption are not so high. They represent overall about 3% of total yearly IT costs for the banks. So then who will pay those costs? Well, it depends on the competition on the payment market. If the digital euro will be introduced, competition will be higher and the banks will not be able to transfer those costs to consumers. So we'll be limited, there will be additional revenues, and then the costs will be allocated depending on competition, and competition will improve.
And now a question for Eric Albert of Le Monde.
Who, by the way, for those of you who don't know, has been one of the architects of this project, and I pay tribute to him.
Eric Albert of Le Monde.
Thank you very much. Good afternoon. Transmission of monetary policy is usually 6-9 months, something like that. Your last cut was roughly 4 months ago, and yet monetary condition did tighten a little bit. Are you worried that transmission is hindered somehow, and therefore you're maybe not in such a good place? Or can you just describe what do you think of the transmission? And I just wanted to come back on growth and uncertainty. There's been a few good news, but does it really justify the kind of positive comments you've made about prospect for growth?
It's always more fashionable to make negative comments whenever you have good news. That I understand. But when we have some good news, we have to also acknowledge and draw the consequences and see what impact it has. Because as I said repeatedly, and as we are determined, we are driven by data. We take into account all data, and we measure the impact that it has in terms of outlook, underlying inflation. And I come to you, the first part of your question, because as you know, we maintain this three-pronged approach that we have had to take into account inflation outlook, underlying inflation, and transmission of monetary policy. And I would add to that, since our strategy review, in addition to pure inflation outlook and the identification of our baseline, we also try to identify and measure risks to the baseline, risk to the upside, risk to the downside, and we use different tools in order to do so, including scenario analysis. Everything that we see in terms of transmission leads us to believe that transmission is effective, is very much on time, and the numbers that we see in terms of interest rates charged to corporates, interest rates charged to mortgages, lead us to believe that that transmission is not impaired at all, but is functioning well. We have seen two things in the bank lending survey. Two things. One is that there has been a slight tightening of the credit terms by the banks, which was unexpected, and that is, in our view and on the basis of their response to our survey, caused by the more attentive measurement of risk of their customers, particularly in the corporate sector. And the second, which is twofold, but it's in relation to households, that interest rate has not budged. It stays at 3.3%. And on the other hand, the volume of loan to households has itself increased. But again, we observe on the part of the banks, based on the bank lending surveys, a more cautious attitude probably in order to better measure the risks that they have. Thank you.
Next question. Sorry, next question goes to Francesco Nifole of Milano Finanza. Francesco, please.
Thank you. My first question is for President Lagarde. Could you elaborate a little bit more about the discussion in the Governing Council about inflation risks? Because in recent days, some members seemed more concerned about upside risk and other members seemed more concerned about downside risk. So what are the positions now? My second question is for Governor Panetta. What is your assessment on the Italian economy and public finances after the GDP data this morning that showed a stagnation in the third quarter? Thank you.
So on our Governing Council discussion concerning risk to inflation, I'm happy to say that we discuss actively, very courteously, in a very friendly manner, and there are different positions and different views and different analysis, and it's often related to where you stand and your perception. So you have a distinction between those who have a more upbeat view and those who have a more downbeat view. You may categorize them as the hawks and the doves, and those categories do exist. But I'm happy to say that on the occasion of this meeting in Firenze, there was absolute unanimity on the part of all members of the Governing Council to arrive at the decision that I have mentioned earlier. Now, let me mention a few elements that we discussed or that we are attentive to. One risk that we have not yet seen materialize and could be a risk to the upside, so we will continue to be attentive to that, is the risk that would result from potential bottlenecks and disruption in the supply chain. We are still to understand exactly what the outcome of the discussions between the US authorities and the Chinese authorities will deliver in terms of rare earth in particular, which is, as you know, a very material segment of the supply chains in quite a few sectors, including the automotive sector, but the energy sector as well. It's not a big amount in terms of actual value, but it's critical at the juncture where it is situated in the production chain. But that risk has not yet materialized. So we shall see. We are in this sort of wait and watch or wait and see mode in relation to that specific risk. There are two other areas that we are attentive to, and that is the composition of inflation. And in that respect, the way in which the labor market evolves, the way in which wages evolve, and the impact that it will have to service inflation are elements that we are also monitoring to understand the impact that it will have going forward. I wouldn't call it a risk, so to speak. You don't find it in the risk section. But I just want to mention these two because they are ingredients that feed into service inflation, which in September has picked up by 0.1%. And they, of course, have an impact also on underlying inflation, particularly domestic. Thank you.
Thank you for your question. Well, the numbers which we got today on GDP was flat, are largely expected, and they do not materially change our projections, the projections we have just published. In order to have a better assessment, we need more information on the composition, because the composition matters. Was the deceleration in GDP growth due to investment, consumption, inventories of foreign demand? Investment and foreign demand have performed very well in the past, so it is important to understand what is the source. But I think we should broaden the horizon and look at the conditions of the Italian economy from a broader perspective. In recent years, the Italian economy continued to grow, although at a moderate pace in spite of a number of shocks that have hit the Italian, like many other economies, the Italian economy and others. The geopolitical tensions, the tightening cycle of the ECB, tariffs, appreciation of the euro, the weakening of the traditional export markets of Italy, the weakening of the German economy is a big headwind for the Italian economy. But overall, the economy has been much more resilient than many would have predicted only 2-3 years ago. And I think we should look at the structural underlying conditions of the Italian economy, which have improved significantly. If you look at public finance, the deficit shot up to above 9% during the pandemic crisis. Now it is at 3%. In 2025, we will go even lower than that. The primary deficit became a primary surplus of 0.9 percentage points of GDP. The debt-to-GDP ratio, which increased significantly during the pandemic phase, now is back to the pre-pandemic level. And what went largely unnoticed in recent years is the change which took place in Italy's net financial international position. We had a current account deficit. We have now a persistent surplus of the balance of payments. And if only 10 years ago, the net financial international position of Italy was negative for more than 20 percentage points of GDP, today we have a positive net international financial position. So from minus 20+% to around 8-9 percentage points of GDP. And this happened, a very rare case, without a crisis, without a forced restructuring due to an enormous shock, which then evolves into a crisis. So this has gone largely unnoticed, but just to emphasize this concept, now Italy is a net creditor country. Every year we give some of our savings, unfortunately, to foreign countries, and our position is positive vis-à-vis the rest of the world.
Turning to our online participants, I'd like to give the floor to Olaf Storbeck of the Financial Times. Olaf, please.
Yes, hello, thank you. Can you hear me?
Yes.
Yeah, thanks, and apologies, I can't be in magnificent Florence today. I have one question, President Lagarde, on something you said earlier in this press conference. This line that the ECB will do whatever is needed to stay in a good place. I think this is new, if I'm not completely mistaken. You've said it, probably not the gist, but you haven't said it like that previously. And I wonder, I think you said it twice already, what do you have in mind? Why do you think it's necessary to make this point now? And what shall we learn from this? And the second question refers to the European emissions trading system, which the next stage is supposed to be phased in 2027. And I think the ECB expects an uptick of, or kind of a one-off effect of 0.3 percentage point on the inflation forecast. There are talks about potential delays. How do you see this from a monetary policy point of view? Could this justify or force you to do a rate cut if it's delayed and then you end up with a significant undershooting of 2027 inflation?
Well, thank you so much for asking these two questions, and thank you for helping me to clarify what I mean. I did not repeat that sentence on purpose or to convey any particular message. If you read carefully our statement, which I know you do, you will see that in the second paragraph of our monetary policy statement, we say, we are determined to ensure that inflation stabilizes at our 2% target in the medium term. So this is all there is to be read about it, and it's a determination of the Governing Council. We continue to be in a good place, and we are determined to ensure that inflation stabilizes at that 2% medium-term target, which is the result of our strategy review. There's nothing else or nothing more to read about me having repeated two sentences. You know, I think you should not overread. Now, more technical, your second question. So ETS2, first of all, has been in our projection since it was on the table and has been in there since 2024. I don't think I would read too much, again, into an expected delay of the implementation of ETS2. And when I speak to colleagues at the European Commission, they are still strongly of the view that ETS2, which is committed, must proceed, and the deadline for implementation is still 2027. What, on the other hand, is being discussed and has been put on the table by Commissioner Opka is, how would I put it, a slight smoothing in the implementation of ETS2, which means that the impact might be spread a little bit more over time, possibly a bit less in 2027 and a bit more in 2028. So overall, as with many other data, we will be attentive, and the December projection exercise will certainly take that into account, that smoothing over a slightly longer period in order to make sure that ETS2, which is so important for climate change purposes, will actually be implemented. Thank you.
The last question goes to Domenico Conti of ANSA. Domenico, please.
Thank you. Madame Lagarde, good morning. My question goes back to money and payments, basically. We in Europe are in an environment in which public money, as you said, and public cash, actually digital cash, is going to be a key feature of the future of payments. In the United States, at the same time, we are witnessing a strong push towards stable coins, towards crypto, and actually what is a ban on central bank digital money. So it is paramount, as I understand, that we at some point reach an agreement, that there is some kind of harmonization at the global level. Now, since you're back from the IMF meetings in Washington, my question is, at what stage is this process, at what stage are negotiations towards some kind of coordination with the US administration? Thank you.
First of all, I would like to insist on the fact that we at the ECB in the Eurosystem are very attentive to innovation, and we are very supportive of innovation. The digital euro, the different options that we're exploring, the way in which we reach out to both suppliers, merchants, banks, which stand to benefit from this system, is a clear indication that we want innovation into money and into this public good for which we are responsible. So for those who would like to argue that we are trying to stifle innovation, terribly sorry, but no, this is you're knocking at the wrong door. Innovation is definitely part of us and part of the DNA of central bankers in Europe. Second, we are also attentive to the regulatory framework in which private forms of money, certain financial instruments that I would not call currencies, and I'm here referring to cryptos, equivalent of currencies as they present themselves, but which are private form of money, such as stable coins, are launched, are reserved against, are made secure, and that was under the MiCAR, which was the European regulation that was issued in order to establish the protection of consumers, enough financial stability, and rules by which some of those issuers were supervised. I observe, by the way, that in spite of the executive decision that was made back in January, the Genius Act, which was issued by Congress in the United States, is also attempting to put together a framework which has a lot of overlap with MiCAR. There are some discrepancies, and there are areas for which we have to be attentive not to create financial stability risk or arbitrage risks that would be detrimental to Europe. This is our job, and we will continue to do that job and to have a dialogue with the Commission, which is in charge of establishing the rules of the game, if you will. But as I said earlier, what we are doing, putting money as a public good on the map and making sure that the anchor is alive and digital as well as cash, is our duty. But it does not stop private issuers to do what they think is their business. They're into market share. They're into penetration of certain spheres of either payment or transactions. But our job is to secure the anchor. Our job is to secure the settlement functions. And we are going to continue doing that, notwithstanding initiatives that some of those issuers will take. And it certainly does not preclude European-based issuance that would be in compliance with the regulatory framework that we have. So it's a vibrant domain, but one where we have to make sure that we do not expose our compatriots or our economy to financial instability risk that would certainly be a recurrence of what we observed back in 1890 in the United States, for instance.
That concludes our press conference. The next press conference is on 18 December in Frankfurt. And up until then, all the best.
Enjoy Firenze.
That was the ECB and President Christine Lagarde speaking in Florence, Italy. This is Bloomberg Open Interest. I'm Matt Miller here in New York. Let's get a look at what's going on in the markets because we had some mega cap tech earnings out yesterday. Massive investments, $78 billion in CapEx between Google, Meta, and Microsoft. And that was for the last 3 months alone. That took investors a little bit somehow by surprise, although, as Caroline Hyde mentioned earlier, we knew they were doing this and we've been embracing it for a year. Meta down 12%, Microsoft off about 2%. I guess investors want to see more commensurate growth in revenues, certainly in the cloud business. Alphabet did show that, 34% growth in cloud and 44% growth in its Gemini adoption over the last 3 months. Joining us to talk about it a bit is Katherine Bordlemay, Goldman Sachs Asset Management Co-Head of Equity Client Portfolio Management. And Katherine, kind of some mixed messages here, right? Because we knew Mark Zuckerberg, this is not the year of efficiency anymore. We knew he was spending as much as he can, and yet investors are punishing Meta today. What's your take on the AI spend?
Yeah, so I think, look, the direction of travel there is up, up, and then up again. So I think taking a step back, if we look at mega tech earnings, expectations were high, and we've actually been beating that. So I think that's overall a really good starting point. 24 hours ago, if we look at the big four hyperscalers, we were expecting them for 2026 to spend more than $400 billion in CapEx. That's been bumped up now to $470 billion. And again, I think when you start to plug in the CapEx coming from companies around that and the sovereigns, again, we're going to continue to see that because this race is fierce and it's only going to get faster. When it comes to investors, I think the question is, where do we go from here? We are seeing more dispersion. This is what happens when you get more breadth, but I do think the big will continue to get bigger.
So, and outside of just these, Mag 7 or the top 10, grade 8, whatever you want. How is the rest of the S&P doing? Because we were seeing a broadening out in terms of earnings growth, right? And we still have had a pretty good quarter so far.
Yeah, so I do think that broadening story is happened. So this quarter, we've had 50% of companies have reported 85% beats, and this is the healthiest breadth of beats that we've seen in 4 years. To your point, with the biggest getting bigger, if you looked at the largest 10% of the S&P, which is obviously very tech-dominated, their profits is 3 times the rest of the market. So that's a pretty big competitive advantage. They have the CapEx, they have the data to win. But I don't think it's just tech anymore, and this is what's getting really interesting. So if you're trying to put additional capital to work, tech is great, but don't forget about other parts of the market. There's other parts of the market that have innovation on sale, like healthcare could be an example, pockets within the consumer and even financials as well.
All right, Katherine, you're going to stick with us here. We need to get to a special interview right now. Caroline Hyde, as I mentioned, is here with us, and she's got the CEO of ServiceNow after it reported better than expected earnings and raised its revenue forecast. Caroline?
Matt, thank you so much. Yeah, I'm very pleased to welcome to your show Bill McDermott, Chairman, CEO of ServiceNow. Bill, you do it again. You beat, you raised, revenues up 22%, growth in current remaining performance obligations strong. How much is AI driving this, Bill?
Everything is about AI, Caroline. You know, right now, the entire global economy is being reshaped around AI. And what's unique about the ServiceNow AI platform for business transformation, it's one engineered platform that covers everything from your IT estate, how you manage security, operations, assets, to the employee customer experience, and obviously also your engineers and how they build software using techniques like vibe coding and natural language. You don't even have to touch a keyboard anymore with ServiceNow. So it's a complete reinvention of how the enterprise runs. And what's different about us is we're putting AI to work for people. After all, what good is AI if it doesn't help people have a better life?
You say that so well, and you've actually talked much about how AI internally is helping you cut costs, build efficiency, build productivity and profit. But what's so interesting, I think the key question for all of software right now is, why does AI LLMs not just eat your lunch? What is it that ultimately makes you specifically integral to the rollout of AI as it does upend the entire economy, as you say?
The most important thing is to reinvent all of these back office operations and companies. So for example, in our company, whether it's IT support or customer support or security and risk, 90% of this work now is being done by agents, but not at the expense of people. The people in our company now have an AI teammate on their shoulder to do the things that they'd really never really liked very much. All the technical, tactical things that a computer or a machine can do very well. So we've reskilled and retooled our teammates so they can do really great work. For example, engineering work or forward deployed engineering work with our customers, or technical architects that help our customers navigate the AI universe that we're operating in. So it's meaningful work, it's exciting work, and it takes a leader to basically reskill, retool, assess everybody in the company and train them for this new environment so we all win together. And we're hiring, as you know.
You're hiring. The companies you serve with enterprise software, they're not looking to just build it themselves. How do you distinguish that enterprise software has to be a link in the chain?
It's the right question to ask, and it's very different in the enterprise than it is in the consumer world. What we built is an AI platform that serves the most complex companies in the world. Caroline, there's 60 years of legacy technology that has evolved in the enterprise. The enterprise is a really complicated place. So when you think about industries, whether it's financial services and managing the regulatory environment, or all of the legacy complex systems that they have built up over many years, you're not going to solve that problem with a language model that's serving the interests of consumer productivity. That takes real enterprise AI. So enterprise AI is very different than consumer AI. But what's unique about ServiceNow is we integrated the platform with all of the hyperscaler clouds. They're all fantastic companies. We integrated with all of the language models, and we integrate with all the data sources in an enterprise so we can be that one AI platform that goes east to west and north to south to fundamentally retool how companies run their business.
That one enterprise AI company, you're taking on Salesforce in a big way, Bill. I got to ask you to get a little fighty here because, look, you're in customer management, but they're looking to get into IT service management where you are. How do you compete? What companies are you taking away from them?
Yeah, well, first of all, what we do has been built over 2 decades. You got to remember, there's only one company in enterprise software that has operated at the rule of 50 plus, and that's the combination of revenue growth and free cash flow margin. For ServiceNow, over a decade, we've been a 50-plus operator. No other company can say that, so we must be good at something. So what is it that we're good at? We have a configuration management database that literally manages the estate of all IT landscape, of all assets, and of all people and corporations in the global economy. Today, we call this workflows, and workflows are really business processes. It could be designed to build, lead to cash, procure to pay, hire to retire. These form in a workflow. That's become the hot button term, but we're the workflow company. Today, Caroline, we have 75 billion workflows in flight as you and I are having this interview, and they're conducting well over 1 trillion transactions for our customers. Very hard to replicate that. But now let's talk about CRM. We're reshaping the customer experience market.
Right.
And how are we doing that? If you look at the market today, the providers in the market take their customers through a multiple cloud experience. So think about it. To serve a customer, I got to log into 7 different clouds,
right, Bill.
which means the customer is getting a very fragmented experience. With ServiceNow, we meet you where you're at. Any channel, you can configure, price, and quote an order. We fulfill that order in the right form factor, and ultimately we service that customer on one platform, end to end. And we did it the old-fashioned way. We actually built it ourselves. So this is a sensational moment for ServiceNow. We're breaking through, taking share all over the world, and we're only getting started.
Up 3.5% on the day. Bill McDermott, we appreciate you joining on the back of your numbers, as always, from ServiceNow CEO and Chairman. Matt, back to you.
All right, Caroline, thanks very much. Bill McDermott, always a pleasure to see you. Thanks so much for joining us from ServiceNow. Let's turn to one of our top stories that isn't exactly AI. The U.S. and China agreeing to a trade truce. Joining us from Washington is Lori Wallach, Rethink Trade Director, and still with us is Katherine Bordlemay of Goldman Sachs Asset Management. Lori, I wanted to talk to you specifically about the president's use of IEEPA powers here. We have had an agreement putting off this battle for a year, but it's likely to come back again soon. How powerful is the president, according to the Constitution, in terms of his ability to put on tariffs?
Well, we're going to get a good insight to that when we see what questions the Supreme Court justices ask next Wednesday in the case challenging whether Trump has authority to use the IEEPA statute, which is the basis for his broadest tariffs, including on China. Right now, he thinks he has unbound, unlimited authority, despite the fact that the U.S. Constitution explicitly grants Congress exclusive authority over trade. So the Supreme Court's going to have a lot to say about how much power the president has.
How has the Supreme Court been thus far? There have been a lot of decisions, especially in the shadow docket in front of the Supreme Court. How have they decided on balance?
So that is a question that a lot of people have pondered with respect to this case. Generally, they've allowed more discretion to the president. But this would be a tremendous trashing of one of the most fundamental checks and balances in the Constitution. If you think about our country's founding, we were hatched out of a trade war. The Boston Tea Party was a protest against unilateral tariffs against tea. The founders wrote a very stark set of congressional control over trade, but over tariffs. There are two different mentions in the Constitution, and explicitly it was to take that power away from the king, the president. So if you think about the implications, ironically, a lot of businesses are focused on, ooh, if the Supreme Court says there is no authority here, then things are going to be really different. They won't be. There are other statutes where there are legitimate delegations where they could impose tariffs, limited, more control, scope, etc. But if the Supreme Court were in this instance to say a president has unbound, unilateral authority, the issue is not so much the tariff rate, but endless uncertainty, enormous amounts of potential new power, either to punish or reward mightily other countries, specific companies, whole sectors. It would be an unbalancing that would be more dramatic than by far, than all of the previous extra grants of power the Supreme Court has given Trump to date.
I want to get to Katherine Bordlemay, and from purely a markets perspective. This whole trade war up until now, when I guess we're back to square one for a year, the markets don't seem to care at all. I mean, we're up 18% year to date.
And China's up 40% year to date, double that.
Why is that?
Well, you know, taking a step back, I think we always maybe perhaps assume that one person in the White House will determine China's destiny, but actually China will control their own destiny. We're seeing that in Trump 2.0. We saw that in Trump 1.0. If we focus on the specific issue at hand, which of course is tariffs and trade, year over year, China's exports are actually up almost 9%. They're down to the U.S., but they're up everywhere else. They've done actually a pretty good job strategizing, moving up the value chain, rerouting. And frankly, there's products that people just want to buy, like Labubu dolls for your children. I'll get them for you. You'll love them. But that company, by the way, that their revenue year over year was up almost 200, 300%. So they're doing well. We still think economic growth is going to be 4.8%. And we continue to see the best performing companies every year come from China. There's real alpha to be found there.
I bought one in Siena over the summer. It turned out to be a fake.
Oh, no.
So I can't believe anyone's stealing that IP. Katherine Bordlemay, pleasure having you with us. Thanks so much for joining us from Goldman Sachs. Lori Wallach from Rethink Trade. Fascinating stuff, and we'll have to have you on again when we get more on this decision. Coming up tomorrow, Sarah Hunt of Alpine Saxon Woods joins us, as well as Blue Owl co-CEO Mark Lipschultz, and we'll break down another round of megacap tech earnings with Craig Moffett of MoffettNathanson and John Blackledge of TD Cowen. This is Bloomberg Open Interest.